You're good to go.
So, Trump tax bill finally passed, and it has a lot of things we thought it was going to have, and some things we have changed. So this is why we stay up to date on the tax law. So President Trump signed this bill into effect on 4th of July. His big accomplishment of this term legislatively. And let's talk about some of the things that it did. I think the most important thing that this bill does is it makes the tax cuts permanent. It not only does it make the 2017 tax cuts permanent from a rate standpoint, so that means your rate won't go up. It was due to go up at the end of this year. Your rate will not be going up. But there were some other things that didn't go up that were made permanent that I think are just as important, particularly for business owners and investors. So this bill was very positive for small business owners, very positive for investors. And what was most positive was, first of all, we got the permanent deduction, permanent expensing for equipment. So that's the bonus depreciation. So you real estate investors are going to be super happy with this because that was made permanent. That means that your property that you placed into service after January 19th of this year, so after January 19th of 2025, is deductible. So that means cost segregations are more important than ever. If you're, by the way, if you're investing in a deal and you're investing in a, let's say, a syndication, and they're not doing a cost segregation, you need to rethink whether you want to invest in that syndication, because that cost segregation could be half of the return on your investment. Literally half of the return on your investment is the cost segregation. So if you think, well, hey, it's still getting a 12% return or a 14% return, but you could get a 25% return or a 22% return by somebody else who maybe had a lower return on their actual investment, but did a cost segregation, you need to run these numbers. So that is a key part of this bill, is you need to always be running the numbers. There are a lot of limitations in this bill based on your income. Now, it's typically your adjusted gross income. So let's talk about what that is. That's before your standard deduction. Now, the standard deduction was raised, but the adjusted gross income target is before your standard deduction. So for example, the no tax on tips, that is $12,500 for a single, $25,000 for a joint, and that only applies if you're married, filing joint, and your adjusted gross income is under $300,000. So what does that mean? Well, okay, let's say that your spouse, you or your spouse is in a tip industry, qualified tip industry like food service, and you go, well, wait a minute, my income's too high. Well, so what we need to do is we need bonus depreciation to bring the income down so that you can exclude the tip income. So you get bonus upon bonus for keeping your income under $300,000. The same is true, by the way, for overtime pay. The $25,000 exclusion for overtime pay only applies to people making under $300,000. So one of the keys here in this bill is keeping your adjusted gross income as low as possible. And then you get these other tax benefits. Child tax credit applies if your income's under $150,000. So there are a lot of these tax benefits, or your $6,000 extra deduction for being old like me. That $6,000 deduction only applies if your income's under $150,000. Okay, well, but that's adjusted gross income, which means it's after your deductions for real estate. or your other investments. So that's why bonus depreciation becomes so important, because you actually compound your deductions by getting the bonus depreciation. So make sure that you're taking advantage of bonus depreciation. The other really important tax incentive that was made permanent in this bill was the research and development expensing. Uh, the research and development costs, I realize it doesn't apply to everybody, but for those of you who it does apply to, it's a really big deal, because what had happened is in 2017, they said, well, we're going to allow deduction, but only through 2022. And then after that, it's going to be capitalized, which means you have to amortize it over this very long period of time. Okay, well, beginning in 2025, you get to expense your research and development costs again. So that was made permanent. So those two things were made permanent. The other thing that was made permanent was the qualified business income deduction, the 20% deduction for being a small business. So this was a huge enhancement to the being the frankly being a small business, because most small businesses were S corporations, were partnerships, were a pass-through business. Well, what does that mean to us? Well, that means that we're being taxed at our personal rates, right? We're not being taxed at the 21% corporate rate. We're being taxed at our personal rates. And so what we want to be careful of is that we first of all, we want our personal rate to be as low as possible. We do that with our depreciation and other investment deductions. And then second of all, what we want is that we want to take advantage of this qualified business income deduction. It's 20%. Now the House had suggested it was going to be 23%. The Senate pared it back down to 20%. So it's still a 20% deduction, but that deduction is made permanent. It still doesn't apply to specified service trades or businesses like accounting, law. Um, my profession doesn't apply to us, but it does apply to most companies that have pass-through deductions. Another thing, by the way, that changed in the Senate bill that is different from the House bill is that the Senate bill would have put limitations on the pass-through entity deduction for state and local taxes. This is where you get to deduct your state and local taxes on your business, right? Even if you're not a C corporation. And the House was going to severely limit that. The Senate does not limit that. That was the Senate bill that passed. It's the Senate bill that was signed into law, and we don't have those reductions. But if you're not if you don't have a pass-through entity, then what you do get is you get an increase in your state and local tax deduction of from $10,000 up to $40,000 if your income is under $500,000. Okay, so once again, you have to bring your income down. So that's your adjusted gross income. So this is we're just adding benefit upon benefit upon benefit if you get your income down. This is why tax planning is so important. This is why having a real long-term tax strategy is so important, because all of these tax benefits that are wrapped up into this one big beautiful bill are there for people who are under a certain income threshold. And you can be under that income threshold. It's just a matter of how you invest. How you invest determines what your income is. First of all, of course, you have to have a business, because if you don't have a business, you're not going to be able to use a lot of these tax benefits. We have one of the restrictions was this excess business loss was extended. Okay, it was made permanent. So you can use your losses from real estate against any business income, but you can't use it against all of your personal income. If your personal income's too high, you're going to lose some of these deductions. That means your wages, right? Your wage income. If it's too high, you're going to lose some of these deductions. So here's what we have to do. You've got to start a business. There are a lot of benefits to starting a business. you need to be investing the proceeds, the income from that business, into investments that the government wants you to invest in, things like real estate, oil and gas. The clean energy credits, clean energy deductions, they're around for a few years still. So you want, if you were thinking of investing in solar, you want to do it right now. Okay, you need to do it right now. If you're thinking of investing in other clean energy, you need to make sure that gets done right away, because you're going to lose the tax benefit of those clean energy or renewable energy investments. So again, what you want to do is you want to sit down with your CPA, your professional tax advisor. You want to come up with a long-term strategy, but you always want to run the numbers. Always run the numbers. Don't forget to run the numbers, because what you're going to see is that we're going to see deduction, compounded deductions. Okay, we have all like compound interest. We're going to see compounded deductions, and compounded deductions means you're getting deduction against deduction against deduction. You could get some credits, all if your income comes down, but that's going to be how you invest. So again, I think the most important part of this bill, besides the extension of the tax rates, I think the most important part is the permanency of the bonus depreciation. That is the biggest part of this bill. There's a lot of this other stuff you've heard about. You're going to hear about more about. You'll hear about the Trump accounts. We'll talk about the Trump accounts. We'll do some deep dives into things like the Trump accounts and other of these provisions. But the most important thing is, let's keep your income down. And for you real estate investors, it's a happy day.